Once I think financial institutions become comfortable with the liquidity, and they're going to start, and our industry has scaled. We believe the price of Bitcoin will scale. I think to our bull case is $1.5 million. Bitcoin, we believe, is a public good. This is financial superhighway. Everyone should have easy access to it and learn about it, because when they start with an ETF, they will learn more, and then they will want to do more in the way of self-custody and just get more involved into the community.
Cathie Wood begins by addressing the role of financial institutions in the adoption of Bitcoin. Once institutions become comfortable with the liquidity and scalability of Bitcoin, they will start to embrace it. She explains that companies are already structuring portfolios in innovative ways, and advisors, especially those focused on risk management, are beginning to understand the risk-return profile of these portfolios. Wood uses an illustrative example: a portfolio composed of 2% Bitcoin and 98% Treasury bonds could potentially outperform a traditional bond portfolio over time. As advisors gain access to more data on this structure, they will gradually incorporate Bitcoin into their clients' investment strategies. She elaborates on ARK Invest's bold price target of $1.5 million for Bitcoin by 2030. This prediction is based on several factors, including declining volatility. When Bitcoin's market cap was $6 billion, its volatility was extreme, but as the network grows, volatility is stabilizing. Wood believes that the long-term outlook for Bitcoin will see further price appreciation as it matures as an asset. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Once I think financial institutions become comfortable with the liquidity, and they're going to start, and our industry has scaled because of companies saying, okay, we can structure a portfolio in this way, and here's the return risk profile of this portfolio. And, advisors in particular know what the risk return profile, when they get that kind of information, like providing your I know you've done great. You should be presenting this on how much more productive Bitcoin 2%, Treasury bond 98% would be relative to just bonds over time. And I think that will continue, and they will be onto it. But, and it's important too, because advisors are always thinking about risk, especially given the last 25 years, tech and telecom bust, 0809 meltdown, COVID, and so forth. So they're always thinking more about risk than return. And you're presenting them with a very interesting dynamic, which is, as we said, the 2 and 98%. This once we get some of these platforms to approve it, we're going to see all kinds of products like that. We believe the price of Bitcoin will scale. I think to our bull case is $1.5 million. Let's go. As we move toward the system that you are talking about, Art, and already we are seeing the volatility is coming down. When it was $6 billion in network value or market cap, the volatility was like unbelievable. But we're seeing the volatility come down, and the world you're talking about is, how far out do you think? We think that price target is a 2030 price target. And how will the conversation change? Because, I know that one thing the core developers will not do is change that 21 million units. The gold price has broken out. Bitcoin's been very strong. The gold price has broken out. Normally you'd say, okay, inflation. If you look at the ratio, I'm going back to the same chart because it's even breaking down now, the ratio of the metals price to the gold price, if you look at that, you will see that we have dropped, meaning the purchasing power of gold has gone up to where we were in 0809, and we're threatening to break down from there. So in my view, and I'd love to get pushback if anybody has thoughts, but that this move in gold and Bitcoin, there is a risk-off component to it. China is blowing up. The debt is overwhelming that economy, and it is exporting deflation big time. And so I think, and it's interesting to watch the equity market hit all-time highs thanks to the Mag 6. But I wish I could show you this chart, and we'll send it to you if you want to send it to this group. A fascinating chart. It's a Goldman study, and they took the highest market cap stock in the U.S. equity market, all equities, all markets. And they divided the highest valued stock, not valued by PE, but the highest market cap, divided by the 75th percentile market cap. Today it's at 800. Its range has been 100 to 750, and that 750 was in the Great Depression. It was 1932. So what was going on back then? So we had the unemployment rate rose to 25%. GDP dropped by 30%. And you had the PPI and the CPI down 25 to 30%. So in what was happening, 1929, 30, 31, 32, what was happening was the market concentrated towards those stocks with cash hoards, free cash flow, AT&T, new innovation, telephone was at the top of the list. And that was a scary time. This is what happens either in scary times or right before a bear market. It happened in 1973, happened in 2000. We think this is, in our view, this is more like 1932. It's going to be very interesting to compare notes on this, given what was going on then with taxes and so forth. But what happened then over the next 3 years is the market shot up and broadened out, and the mega caps way underperformed, but the market was very strong. We had intended, before the spot Bitcoin ETF was launched, we had intended to take a percentage of the fees and donate them to open source developers. But what happened when 11 came in at the same time and this fee war began, we pivoted and we said, wait a minute. Okay, so the fees will not be 50, 60 basis points. They will be 20 basis points, roughly. And so we're not really going to make any money on that, but that's okay, because Bitcoin, we believe, is a public good. This is financial superhighway. Everyone should have easy access to it and learn about it, because when they start with an ETF, they will learn more, and then they will want to do more in the way of self-custody and just get more involved into the community. So we decided not to do it then, but we've launched private funds, much higher fee, and we're not going to donate 1% of profits. We're donating 1% of revenues.
Wood believes that Bitcoin's share of asset allocations will grow significantly as more institutions and investors recognize its potential. ARK Invest has conducted studies on optimizing portfolios by minimizing volatility and maximizing the Sharpe ratio, a key metric for traditional financial asset allocators. Based on this research, ARK recommends that investors allocate at least 2.5% to 5% of their portfolios to Bitcoin. This allocation strategy mirrors the rise of other asset classes, such as real estate in the 1970s and emerging markets in the 1980s and 1990s.
In the early 80s in New York, active equity management that's all there was, really. And then we hit the tech and telecom bubble and bust. We hit 08, 09, we hit COVID, and the risk aversion in the markets today. The reason that younger people like our strategies is for the same reason they put up with the volatility, and ours have been extremely volatile, especially lately, is because they know we're doing the research and they know this is the way the world is going to work. So they will do the right thing, which is, okay, average in, or however they do it. I have found the fortitude of young people has been enhanced by the Bitcoin movement in terms of our strategy. There's no way we should have retained the assets, in the old world that we have, except for the younger people coming in, and people, not just younger, but people who are very interested in the research, how the world is going to work, not how it has worked. We're in the biggest moment of, disruptive innovation in history, with Bitcoin, a prime example. This is a new asset class. We wrote that paper, Bitcoin, ringing the bell for a new asset class. And what it does, I may not be answering in the way you expect me to, but what it does in terms of the way the financial markets are set up right now, and I agree, they're going to have to change, and they will change. But any fiduciary knows that if you introduce a new asset class into your asset allocation, the correlation of the returns associated with that asset class are going to be low relative to the other assets. So it's important to include it to increase returns per unit of risk. It's that low correlation that lowers the risk of the portfolio in general. So, that's how we've positioned what's going to happen near term. Longer term, I guess, we shall see. I think there are going to be share shifts in terms of this asset class, given the kind of appreciation we expect. We think its share of asset allocation will go up fairly significantly. And we did a study on that as well, using, minimizing volatility, maximizing Sharpe ratio, all the things that traditional financial asset allocators look at. And right now, or in our published piece, we said, you should start out with at least 2.5% to 5%. And that is how a new asset class starts. I remember in the 70s, when I was very new to the business, real estate was a new asset class for pension funds. Then in the 80s and 90s, emerging markets became a new asset class, because MSCI had basically said, you don't have to take a risk on what this country or that country. Here, we're going to bundle these. So it became actually a new asset class. And here we are, at the threshold of yet another new asset class, Bitcoin leading the charge. So I think the ramifications for Bitcoin are going to be quite significant, and it will take share, as will other crypto assets, I think, from traditional financial assets.
Wood asserts that Bitcoin is leading the charge as the newest asset class in the financial markets. Its potential to disrupt traditional financial systems is immense, and as adoption increases, Bitcoin will take a larger share of asset allocations. She foresees a future where Bitcoin and other crypto assets will continue to grow in significance, ultimately challenging traditional financial assets. Please like and subscribe my channel.